Good morning, good afternoon, good evening, depending on when you're watching this. Hope you're all doing well. Chris Lawhead here talking about capital stewardship, lending, private equity. And a buddy of mine sent me a Wall Street Journal article today. Let me share this with you all. Talking about mortgage rates and mortgage rates heading into the sevens for your normal home buyer, right? Good credit, down payment going into the 7% range. So the Journal posted this a few days ago, talking about rates approaching 7%. At the time of this article, the average, according to Fannie and Freddie, was 6.96. I call that 7. I've seen this in my lending practice quite a bit. People are home buyers, normal home buyers, are hoping and predicting the peak of mortgage rates, right? Home buyers, please listen closely here. You do not have a crystal ball that is accurate in predicting mortgage rates. In fact, nobody does. I don't. The famous Case and Schiller do not. Nobody has the crystal ball that works. And that's been proven over many, many years of folks trying to predict it. So yeah, rates dropped a bit in 2023, but they've been elevating and rates have been continuing to go up. The Fed is obviously trying to get inflation contained. Now, mortgage rates aren't directly related to the Fed, but they are certainly indirectly related. And I've heard a lot of lenders, and this is what scares me a little, is you have lenders talking about, hey, don't worry about that high interest rate you're getting right now because rates are going to drop at the end of the year and you'll be able to refi out. That's a heck of a prediction to hang your hat on if you're a normal home buyer, working on your housing budget, working on your family budget. So yeah, they could slip to 6% by the end of the year. Even who's talking about that? Oh, Lawrence is talking about that right now, the chief economist of the National Association of Realtors. But he also acknowledges that if the Fed continues to be aggressive, then mortgage rates could hit 8% by the end of the year. So they could be down to 6, they could be up to 8. I think that's a very accurate potential spread there. Now, like I said, mortgage rates are closely tied to the 10-year Treasury yield, and they're closely tied to the Fed, but they're not directly. And we've seen a bigger spread between mortgage rates in the 10-year than I've seen in a long time. Generally, as lenders, we watch the 10-year, and you can predict the same day if they're going to go up or go down, right? Because if you see the 10-year skyrocketing up or the 10-year taking a nosedive, then you know whether to lock your client's loan immediately or to hang out for a few hours and let those lower rates permeate the system. But we've seen a bigger spread relative to the 10-year than I've seen in a long, long time. Again, the Journal here is talking about, rather than trying to make a bet on the directions of rates, potential buyers should focus on what they can control. I couldn't agree more, right? Focus on you. Focus on your family budget. Focus on getting your monthly expenditures in a reasonable range, right? Pay off your car. Don't get big car payments. Handle your credit. I always tell clients there's no crystal ball. Nobody has a crystal ball that works. And so I equate it almost to lending malpractice to be telling these folks, hey, don't worry about those high rates now. I know you can barely afford this payment now, but don't worry, your rate will drop and we'll refi you in December. Whew, that's a risky one because nobody's crystal ball works. So, what I would say is downsize your expectations, right? And I know I seem to be reading this out of the Journal, but I like where the Journal's going with this, right? Higher interest rates means your budget won't go so far. Duh. I'm a big fan of living within your means. I know a lot of you who know me know that fact. I would just be trying to control what I can control, which is your monthly payments, right? Maybe you can't buy as big of a house as you want. Maybe you need to downsize. Maybe you need to consider the neighborhoods you're looking at, right? Or maybe you can afford it all. I mean, the Journal throws some of these examples here. They're talking about shopping for the best possible rate. And you've heard me talk about this many, many times. What was it? The HMDA data, the Home Mortgage Disclosure Act. Listen, if you're a lender, you have to disclose your interest rates, what you're doing with clients, what loans you're getting for clients consistently, right? The Home Mortgage Disclosure Act, HMDA, makes all lenders provide data, and we get to see that data. It's made public. And your standard home buyer across the country has been shown to save some bucks using a mortgage broker, right? I know I have some great banker friends. I love some of you. And I'm also, I have a lending practice. I have a mortgage brokerage practice. Although I have reduced my exposure to that while my team just rocks it, and I get to do some other cool private equity stuff in real estate. But the data is quite apparent. You save money on average with a mortgage broker because they're shopping your loan to 60 different lenders, right? They're making lenders compete every single day. You do when we lock an interest rate for somebody, we go onto a program called Loan Sifter. We look at the best pricing lender, the worst pricing lender, and then we say, hey, what will in the top 5 or the top 10 of these best pricing lenders, who do we like working with? Who's easy to work with? Who has crazy overlays? Who doesn't? Who's the best fit for this loan? And we go with them, right? And that best pricing lender is not always consistent. It's not always the same lender. So anyway, that's the power of the broker. But like I said, nobody can predict mortgage interest rates. Nobody's crystal ball works. They're all broken. So if you're a standard home buyer, please, please, please don't get stressed out by trying to predict the movement of the mortgage rates or trying to predict what the Federal Reserve is going to do. I know some very, very smart people, and they don't know, right? So anyway, I'll get off my high horse. It's like that. Hope you're all well. Wishing you health, wealth, and happiness. Talk to you later. Bye-bye.